Hello friends, a very warm welcome to my channel. In this video we are going to talk about a company called Epack Durables. This company works as an original design manufacturer for RACs, washing machines and lot of other interesting products. The manufacturing space in India is expected to grow leaps and bounds even from the current stage. China plus one strategy globally has been working out quite well, and even if a minuscule portion, let's say just about 5% of the manufacturing base in China, if it shifts to India, then in terms of amount of production in India, we can grow by leaps and bounds. These kind of companies are a good way to play the manufacturing theme in India. And as the company is into the consumer durable space, the domestic consumption of these products is bound to grow consistently in the next few years. So if you're new to the channel, please do subscribe and hit the bell icon to get the updates of all the new videos which I upload. And if you're not a part of our Telegram channel yet, do join today by clicking the link in the description so that you join the correct Telegram channel. Every morning before the market opens, I share my views on the market and also share a lot of portfolio strategies which can increase your portfolio returns. So this will be the flow of our discussion. We'll discuss the business model of the company in brief. We'll look at the stock performance in the last couple of years because it's a recently listed IPO. We'll look at the basic financial parameters. We'll talk about why the stock has given the recent rally post-listing. We'll understand what is the outlook of the management going forward. We'll understand the valuations of the stock at present. We look at the risks of investing in such businesses and then form an overall view about this company. So Epack Durable was started in 2003. When this business started, it started as a OEM business or a contract manufacturing business. Now, what is the difference between pure contract manufacturing and a ODM business? So now this company has transformed itself into a ODM. So a contract manufacturer does whatever their customer says. The customer has complete control over the design and everything, and the contract manufacturer only manufactures as per the specifications given by the customer and hands over the product to their customer. Now what a ODM does is the customer may come with just a requirement of a product. The ODM, which is the original design manufacturer, can do the end-to-end process right from design, prototyping, then sampling, manufacturing, developing the product, and thereafter delivering the product. And they will also give some assurance of or warranty of the quality of the product to their customers because they want to maintain a long-term relation with them. So starting as a contract manufacturer, this company has transformed itself by enhancing their capabilities into a ODM. Now for which products this company is doing the ODM? Mainly they are doing it for the air conditioners, which is forming around more than 80% of the revenue, and other than that they are also into other products like washing machines, induction cooktops, then mixer grinders, water dispensers. So gradually they are diversifying into other products to reduce their single product dependency risk. Now who are the customers which this company is working with? All the big brands in India are their customers like Voltas, Haier, Philips, Godrej, Daikin, Havells, Bosch. So by looking at these names, you are rest assured that the quality of the products manufactured by Epack Durables is good. In terms of capacity, they are the second largest in India. And in terms of market share, they hold about 24% market share of the products which are manufactured in India. They have complete backward integration as they are a design-led company, and a lot of critical parts of their products are manufactured in-house by this company. They are diversifying the product base, as we have discussed, from air conditioners to other products. They have 3 manufacturing facilities in India and 4 research and development centers with over 70 people working in their R&D team. So it's an innovation driven company. Not just the customer comes with a requirement, but they also keep improving their product quality and offer better quality products, better technologies to their customers year on year. If you look at their segmental revenue, nearly 81% of the revenue comes still from RACs, but year on year it will gradually go down to around 70% is what this company says. In terms of installed capacity, these are the numbers: 1.6 million indoor units, 0.62 million window ACs, then 0.62 million mixer grinders. So all these are the capacities of the company. If you look at the stock performance post listing, the stock was hovering around somewhere around the IPO price itself. In fact, it was lower than that, but due to the recent good numbers, the stock has given a good rally and it has made a high of somewhere around 400 rupees. The IPO price was somewhere at 230 rupees. If you look at the revenue performance from FY21, it had done a 736 crore of revenue in FY21, which has gone up to 1700 plus crores in the trailing 12 months. So the growth in the last 4-5 years has been more than 2x in terms of revenue. If you observe, there was a small dip in revenue in FY24, which shows that the growth has not been very consistent year on year. In terms of EBITDA, it has grown from 40 crores in FY21 to more than 130 crores in the trailing 12 months. So EBITDA has grown much faster than revenue. This shows that there was margin expansion. and this has grown more than 3 times. In terms of margins, as we have discussed, it has gone up from 6% EBITDA to 8%. Generally, the margins in these businesses are lower because they are manufacturing on behalf of the other brands, so this is not a high margin business. The company has done some capex recently, due to which the ROE has gone down to just about 6%. Promoter holding is 48%. So if this company wants to raise further fresh equity, there is a risk that this promoter holding can further go down. In terms of inventory days, it is holding an inventory of almost 3 months, so working capital becomes very important for this company, and with the efficiency with which this company maintains working capital becomes critical. Now, what is the reason for growth in the stock price in the last 1 year? In terms of sales, it has shown a massive growth. There was margin expansion. Earlier, whatever multiple the market was giving post listing, that multiple got re-rated, and now the company is getting a higher valuation multiple. And the sector is a in-theme sector, as everybody knows that China plus one is a long-term theme which is going to work in India. So people are willing to pay a higher valuation for the companies working in this sector. In terms of growth outlook, the management says in FY25 they will grow their revenue by more than 45%. They will maintain similar margins in FY24 as of now. But going forward in the long run, as their product mix changes, there can be a slight improvement in their margins. Now, there are certain tailwinds in this industry which may lead to higher growth for this and all the other companies working in this sector. Whatever products are getting imported from abroad, government is slowly imposing certain restrictions or higher qualifications to make it a little difficult for import, so that the domestic products get used by the companies. Now, what are the steps which the government is taking? The government has introduced BIS certification for more and more products. So not every country and not every seller in that country is BIS compliant. So this makes it difficult for them to supply their products in India, and the domestic industry gets boosted up. They have imposed a ban on import of gas charge units. The government is introducing several PLI schemes so that these manufacturers get benefited. So by these kind of different measures, the government is promoting the companies which are manufacturing in India. The company is also looking at an inorganic acquisition. So they have formed a joint venture with another company for manufacturing different motors. In the starting, they will manufacture BLDC motors, and they will gradually diversify these products. So these motors are used by the company captively in-house for their production, as well as they are open to sell it to the other manufacturers as well. So the name of the company which they have formed as a joint venture is Epack. These are the new products which are in the pipeline to be manufactured by the company. They will be starting soon the FA washing machines, room oil heaters, air fryers, star fans, water heaters and hair dryers. So when you talk about the valuations of this company, in the trailing 12 months, it is trading at a multiple of almost 79 times. And the price to book value is about 4x, and the market cap to sales is about 2.2x. So from the recent corrections, the valuations have already got re-rated, and these kind of multiples of 80 times are not cheap. But when you compare it with peers like Amber, these valuations are still lower. But Amber has a consistent track record in the listed space for a longer period of time. So that's why it commands a higher premium than these kind of companies. What are the risks of investing in this business? If the commodity prices fluctuate, the margins of these companies can get impacted. If the government makes the regulatory changes, if they reduce the number of benefits which they are giving to these companies, if they lift the import bans which are there on these products, then these business can be at a very high risk. In terms of technology, the companies which are their customers expect them to make latest products. So if they don't upgrade the products and make them using latest technologies, they would prefer to buy from the other countries like China. There is more and more competition in this space. There are companies which are bigger than this, and in fact smaller than this, like Virtuo Opto Electronics, which are going to give tough competition for these kind of companies. There are limited brands in this space, so there is customer concentration. So if they lose one of their customers, the relations get spoiled, then they can lose a large chunk of revenue. As of now, this company has a single product dependency, as more than 80% of the revenue is from RACs, and the promoter holding is already below 50%, so further dilution can be a risk for the investors. So now that we have understood the business model of the company, we have looked at the financials, we have understood the risks of investing, the growth plans and the valuation. Now, what is the view on the stock? So somebody who is already holding this stock should continue to hold, as there is clear visibility of growth and guidance given by the management for the next few years. They are doing all the right things, as product diversification, capacity expansions, and this theme is also good for the country. If you're looking at a fresh entry after the recent rally, then the risk reward is not too much in your favor. So we should wait for the stock to cool off a bit and then gradually accumulate from a long-term perspective. So that's about Epack Durable. I hope you liked the crispy video. I try to accommodate all the important points you should know as investors to take a decision in this 10-minute video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the names of the stocks in the comment section. In fact, this stock's name was also picked up from the comment section of the last video. Do join our Telegram channel by using the link in the description button. It's a free channel. Thank you for watching and have a wonderful day.